The Federal Reserve raised interest rates again in its effort to fight inflation. The latest hike puts interest rates at their highest levels since 2006. Consumers are feeling the tug on their wallet with rising interest rates for things like loans, mortgages, and car payments. But the Fed says a pathway still exists for a soft landing. This latest move is part of a bigger month-long effort to help the U.S. avoid a recession. Let's dig into where the U.S. economy stands right now, starting with where you're going to be shelling out more money due to higher interest rates. The Federal Reserve raised interest rates by 1/4 percentage point on Wednesday. It's the 9th hike in a year as the central bank fights inflation.
It's proceeding more slowly than we would have liked, but it's certainly proceeding.
Rising prices for staples like bread and milk are costing American households an average of $372 more a month. Meanwhile, the rate hikes have made borrowing more expensive, such as for mortgages and credit cards. Nationwide, existing home sales actually increased from January to February, but are still down more than 22% from last year.
It appears that interest rates are going to continue to rise, and if that's the case, then it's better to get the foot in the door now.
High interest rates combined with high sticker prices fueled by high demand is making it more challenging for car buyers.
We're still seeing very strong demand, but you can feel it that it's slowing down.
Although prices have dipped slightly from historic levels, new cars still come out to nearly $50,000 and used $28,000 on average. Combined with APRs that can be as much as 11%, monthly payments are skyrocketing. 1 in 6 people who have recently financed a new car committed to monthly payments of $1,000 or more, the highest on record. Demetrius Thatcher depends on his vehicle to make food deliveries just outside Atlanta. After a crash totaled his previous car last summer, the Navy veteran reluctantly purchased a new one for about $25,000 more than he wanted to spend.
I called around to the other dealerships. They were like, "We got nothing."
He says he's now paying about $1,000 a month for his car and had to defer payments twice. Delinquencies for auto loans 60 days or more past due are up 20% from last year.
Consumers are served a double whammy because car prices are high and interest rates are high.
Jessica Caldwell analyzes auto transactions for Edmunds, a car shopping platform for new and used vehicles. She says there is a bright spot for those in the market for a car now.
We are seeing some automakers actually offer incentives, and we haven't seen that in a while.
Fed Chairman Jerome Powell says it could be several years before the central bank hits its target.
The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy.
$1,000 a month for a car payment? I think I'd break out my bike. You know, all this comes after just 13 days ago, the U.S. saw its second largest bank failure in history when Silicon Valley Bank fell. Only 2 days later, the U.S. saw its third largest bank failure with the Signature Bank collapse. After the recent banking system stumble, the Fed now expects to raise rates just one more time this year. Some financial experts are calling it a necessary slowdown.
We are really in the middle of this period of time where we don't know how banking conditions are going to work out, and we don't know the impact on the overall economy yet.
Regulators have repeatedly expressed confidence in the banking system following the collapse of Silicon Valley Bank and Signature Bank. Treasury Secretary Janet Yellen told Congress that banks are taking action to survive in the event of a bank run.
Banks across the country are shoring up their liquidity. They are very worried about contagion.
She is pledging to support smaller banks.
Our intervention was necessary to protect the broader U.S. banking system, and similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion.
Mark Zandi, chief economist at Moody's Analytic, says the bank failures have given the Fed a tough job.
Trying to thread the needle here, balance things, trying to do enough to help support the banking system and financial system, get that on solid ground, but at the same time continue to fight inflation.
Following the bank failure, CBS News conducted a survey to find out how Americans feel about their own bank and the U.S. banking system overall. 3/4 of Americans have at least some confidence in their own banks, which is more than they have in banks and financial institutions as a whole. But when it comes to the security of your own money, our Verified team found out just how much is really insured.
The number of people searching for an answer to the question, should I pull my money out of the bank, spiked over the last few days following the collapse of Silicon Valley and Signature banks. So, is your money safe at the bank? Let's verify. Our sources are the Federal Deposit Insurance Corporation, the Federal Reserve, and Associate Dean David Eli with San Diego State University's Fowler College of Business. Almost all banks pay the FDIC for insurance. This ensures that in the unlikely event of a bank failure, deposits under $250,000 per account holder are protected. This applies to checking, savings, and money market accounts, certificates of deposit, cashier's checks, money orders, and negotiable order of withdrawal, or NOW accounts. So, yes, if you have less than $250,000 in each account, your money is safe, and there's nothing to worry about. If you have more than the limit, then Eli suggests spreading your money to different types of accounts, since each one is protected up to $250,000. So why were people panicking after SVB collapsed? 9 in 10 account holders at the bank had more than $250,000 in their accounts, meaning they were largely uninsured until the FDIC stepped in and said they would protect all of their money.
So where did the FDIC get the money for the bailout? Well, the Federal Reserve stepped in using money from the Deposit Insurance Fund. That program is funded by fees paid by banks and interest earned on government bonds, not taxpayers. The FDIC says it will require banks to pay a special assessment to help recover any losses. WFMY News 2 at 6 is next.